Okay, well, we're just going to have to go with it, guys. So do bear with us, because everything seems to be working my side. Um, it could just be one person. Maybe just turn up the volume on your screen, perhaps. Um, the other thing, right, so we've got, so the treasury yields and stocks are one thing. So the decline in stocks, the decline in treasury yields, two very weird things. Um, now obviously, the other thing that we need to do is uh, is when you see treasury yields decline, stocks decline, that can sometimes be bad news for the dollar, and indeed it has been. The dollar index is back below 80, which is quite negative. We also have, that actually leads on to the second surprise, which is the benefit for the rebound, I should say, in euro dollar. In fact, let's start on that chart. I know some people have asked me to look at other things. I'm just going to go with euro to start with, because I do think what's going on in the euro is quite a good roundup for what's going on elsewhere. And I do apologise, guys. I do have a bit of a cold at the moment. Someone is saying now, are the falling equity markets a result of tapering in the US and no additional stimulus by the PBOC and the Bank of Japan? I think that's a good one of the many reasons. I think that the other reason could be that the US economy maybe wasn't as strong as some had expected. And then the third reason could be that we are leading up to Q1 earnings season. We get that kicking off tonight with Alcoa in the US. Then we get a lot of bigger names coming out at the end of this week, including US banks. Basically, if there is not enough, if the earnings aren't good, then stocks at record highs, they don't deserve to be there. So that's kind of a key thing to point out as well. Now, looking at the euro, just as I said, this was a bit of a shock. So Friday, so as you can see, last week, most of April, bang, 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 lower. However, we did manage to bounce off support there at the 100-day moving average, which came in at 136.94. So as you can see, we've moved higher. We are currently trading around about that 137.70 level. That's just causing a bit of stickiness. One would expect that. A lot of people were looking at that level. And a lot of people were looking at that level as kind of your first take profit zone. Above here, we get to these highs from the very beginning of this month, which come in around about 138.20. Trying to fundamentally rationalize why the euro's gone up. I think, some people say, oh, it's a Teflon currency. I don't know why it's doing so well. I think if you look at the eurozone as a whole, though, it is doing quite well. I mean, there are countries that are obviously suffering. Of course, there are other countries that need massive amounts of adjustment. But actually, if you look at, Germany, for example, doing well. We've got, lots of, France picking up, definitely. All this adjustment is actually one of the, dealing with their issues rather than the US, which kind of hides them, but dealing with them, strengthening their finances, strengthening their institutions is possibly one of the reasons why countries in Asia are actually treating the euro now a bit like a safe haven again. They're seeing it as, something they want to invest their money in. And we know that, there has been demand for euro from coming from the East, from China in particular. And that is that's a powerful driver of the euro and has propped it up at periods of crisis before. So we are seeing, is it Teflon currency? Is it, its inability to fall? Is also because, the market is appreciating what they're doing to try and turn their economies around. Now, it doesn't happen quickly. Obviously, you have some sclerotic economies, France being one of them, but Italy definitely probably being the worst there. That they are slowly taking steps. They're Italy's got a new government in who hopefully will make some change. The unions are getting a bit weaker, and hopefully that will move things. But that's the kind of the big fundamental broad brush view about why the euro could be in demand. The other reason is that yes, there's been mention of QE, but that's all that there's been. There's been mention of QE. In reality, implementing QE in the eurozone is almost impossible the way things stand now. They'd have to change the ECB's mandate, and to do that, you would have to get every government in the eurozone to agree to the change. That's going to be a massive piece of work. You probably wouldn't get it in. That would have to be something so enormous that it would take many, many months. It wouldn't help with the summer recess. So QE is definitely not going to happen in the eurozone anytime soon. You've already seen some of the German financement, some of the German authorities, even some from the other countries, actually turn back and say, well, we've got a very narrow mandate. Yes, they're willing to tout it and throw it out there, but they've got a very, very narrow mandate. And I think the market just isn't buying it at the moment. instead, what they're trying to see, is is whether or not they can talk down the euro. They can't seem to do that at the moment. I think that, if we get back to 140, we could see some more aggressive starts. I think, if we can hover around here from where we are, probably somewhere in the region over the next few months between 134 to 138, I think that'd be relatively happy. So I had some comments here. Euro is more reputable than the US. I mean, some people would argue that, and yes, you could probably argue that is from an investment perspective, because obviously the Eurozone hasn't embarked on, or the ECB hasn't embarked on QE. So there we go. They've dealt with some of the hard things, or they are dealing with some of the hard things, and the market's rewarding them for it. So that's one of the reasons why the euro is moving higher. Dollar Swiss going much lower, euro dollar going higher. Well, yes, one would, there is a little bit of an inverse correlation there. And obviously it's all to do with the dollar side of this equation, in the sense that the dollar is looking fairly weak. Just take a quick look at this dollar index chart right now. As you can see here, I mean, the recovery has been pathetic at best. Yes, last week it looked a little bit promising. Are we going to get to that 200-day moving average? But I think until we get above that 200-day moving average, which comes in around about 80, I don't think really that the markets are going to... I don't really think that the market is going to do too much. Trust this dollar. They're getting exasperated by the dollar. Wherever, there's always just a quick one. Sorry, someone else is saying that they can't hear anything. I think you may just have to log in again. The people obviously are able to log in, so I don't know. Don't if you want to send messages to FX Street admin. Okay, so just going back to this, the strong dollar theme was, key thing for 2014. Well, it hasn't panned out in the first quarter. The market's losing patience, and we're just not seeing the follow through. Today we've got it's a fairly quiet data week. Next week and the week after really could be fairly quiet as well. What with Easter stuck in the middle there, and some Jewish holidays too. We're not really seeing a huge amount of volume at the moment. It ticked up a little bit. Even on Friday, it ticked up a tiny bit, but not too much. And that's it. I'm talking about in stocks here, obviously not in FX, so it's not traded on the exchange. We're not seeing a huge follow through on some of these moves. So, there just doesn't seem to be the pent up demand to buy dollars at the moment. And that is why the dollar isn't rallying. As I said, it's quite a quiet data week this week. We could potentially see some reaction to some Fed speakers. We have Koch Lakota later on today. It's about 18:30. I think he's speaking London time. He is a noted dove. Then we have Plosser talking a bit later on after Koch Lakota. He's a hawk. And then we have Evans speaking at 9 o'clock London time. He is neutral. So at the moment, it'll be really interesting to see how they play out, because at the Fed at the moment, we do have kind of a few vocal doves combined with a good few kind of centrists to slightly dovish people. How's the argument? How's the debate going? Do they agree with it? Are the hawks being well represented? Are they able to start? Are they going to be able to push their agenda on the broader market? All of this thing is quite important, and is certainly worth watching. So, that's they're the comments that could potentially move the dollar index. And one thing we do know is that Fed commentary can dramatically impact what's going on. Now, obviously, these aren't the big hitters. They're not the Yellens and the Dudleys, who are very, very dovish. But for the time being, just weigh up what's going on with the Fed. Stray Fed comments here and there could certainly get this thing moving. But as I said in the dollar index, the path that leads to resistance seems to be to the downside now that we've kind of pushed through that 80 level, given back all of those gains from the end of last week. And until we get back above 80, 81, it's going to be very, very difficult for us to see a sustained upside. And that's the 200-day moving average there. Pan, you're saying it's very difficult to try to figure these fundamentals. Might just stick to the charts. I completely agree. Fundamentals are what drive markets. But looking at the charts, I think you can see right now that dollar move is weak. You can see it here, right? We didn't even get near the 200-day moving average, and that's an important level. I mean, look at the tight range that we're trading in. Even if we go back to euro, just looking at a five session chart, we're trading in a very tight range. Yes, we're close to the top of it, but really this range looks like it could be here for a while. It's not this is not a big market moves by any means. We are still in very tight ranges, and it's largely because of what's going on with central banks. So central banks, when they get involved, they kind of ruin things, and it gets very, very annoying. Just looking at kind of where we are right now, any kind of levels that we've got to watch out for, kind of as we mentioned already, euro dollar is certainly kind of getting back gains, but I would say that it's still very, very quiet. We haven't broken any new ground. We need to get above 138.20 to do that. There seems to be some buyers around about that 137 level if we are to see a bit of a drop below there. We may see in the very short term some more strength in euro. That's kind of our view here. Someone mentioned about Swissy, and yes, dollar Swissy has been again tried to rally. What's going on here? Sorry guys, tried to rally but just wasn't able to pull through, and that's really it looks very similar to the dollar index. If the dollar's not rallying broadly, it's not going to be rallying against the Swiss franc, especially since last week the Swiss franc since the onset of this week, the Swiss franc has done quite well. Breaking below that 50-day moving average in the dollar Swissy as well, which comes in at 88.79, was also a bearish development that opens the way back to 88 and the lows from earlier this month. It's breached that kind of 89 level support. Now it's well breached it. It's breached that 50-day moving average. Again, the path of least resistance seems to be on the downside. I just don't see any big driver in dollar Swissy right now to push us one way or the other. I see us as trading a bit of a range. The top of that range looks like the 100-day moving average, and the bottom looks like those lows from earlier from 88. I could see us trading in that range certainly in the short term anyway, as we wait for those minutes coming out of the Federal Reserve tomorrow. But Pan, I completely agree with your sentiment that the fundamentals are just too tricky and it's better to stick with the charts. Let's also take a quick look at dollar yen since we're on the dollar side of things. Dollar yen as well. I mean, it's your typical range bound. It's so frustrating. We saw the BOJ do nothing today, but we are testing support there at 102, just above the 50-day moving average, which comes in at 102, just below 102.40. That's the pink line on this chart in front of you. Back to where, again, this is just another reaction to what happened post payrolls. A fairly solid payrolls number. There were pockets of weakness, which I would argue is what was worrying. But we have, we're backing away from those highs at 104.20 and just looking very lackluster, really. Still stuck in a real range, just unwillingness to push things up on the upside. I think that's the key worry here. We are getting close to good support though. 101.30 looks like good support. That's the low from here. If we do go anywhere lower than 200-day moving average at 100.80, it's certainly worth looking out for. There's a bit of a gap to go from there, and obviously if we can get a daily close and stay above the 50-day moving average, that could be good news in the short term. But I don't see real direction here right now. Or with the Federal Reserve, nothing new from the Federal Reserve and the Bank of Japan staying on hold. Dollar CAD, yes, Alan, the dollar CAD was a big mover on Friday. It really reacted to maybe the market's lackluster reaction to the US payrolls data and the much better than expected Canadian data. The market had kind of got used to some weak Canadian data, and it just goes to show how surprises and fundamentals, particularly from countries and maybe currencies that aren't taking center stage right now in the G10, is really having a big impact on the markets. If we look here, we've well and truly fell below that 110 level. We're now getting very close to the 100-day moving average at 109.02. We're currently trading around 109.27. I just want to draw on a couple of other bits. From the lows of January to the high that we saw in March, we're now through that 50-day moving average, which came in around about. We're now through that. We're well through the 50-day moving moving average, as you can see. But from the lows in Jan to the highs of March, we are through key support, which was a 50% fib retracement there, which came in at 109.35. Below here is 108.54, which is 61.8% retracement. That's below the 100-day moving average. So there is certainly support on the downside, but there could be room on the downside as well. Now, today we do have some economics and housing data out of Canada. It will be interesting. Let me just bring up when I let me just bring up when the next kind of when I could speak to there isn't really another Canadian central banker speaking for a while. Bank of Canada rate decision is on the 16th, so that's not until next week. That will be really interesting to hear how Governor Pollard reacts, whether or not he reacts to the stronger Canadian dollar. I think it's kind of interesting. I'm not 100% sure he will. I mean, we're still weaker in the Canadian dollar relative to where we were in January. And again, the market could possibly second guess that there isn't too much that the Canadian authorities can do right now if the economic data is picking up, particularly in the employment section. So Haroon, you were asking about sterling. Yes, there was better numbers out of the UK today. That came on the industrial front, and good timing for it as well, because obviously we're now looking towards the Q1 GDP release, which isn't for a few weeks yet, but we are kind of moving in that direction, and we are moving towards that number. So obviously good industrial data suggests that maybe the industrial sector played a bigger part in the Q1 numbers, and that could kind of boost GDP going forward. So as you can see here, big daily candle, big move higher in sterling, which again is not just it isn't, in fairness, just benefiting from what's going on with the UK economy. It's also benefiting from that weakness and the inability of the dollar to rally. So, where could we go next? We're still trading in a range. It's the top of that range, surely. 168.23 is still that high, with those lows being, for now anyway, the 50-day moving average, which is capping the downside nicely at 165.90. So a nice big rally in the pound today. There could definitely be further upside. I don't think just the industrial data alone will be what does it. But remember, the market is pricing in now a strong Q1 figure. So, as we go through this month, data for kind of February, March, that's going to be, the market is very sensitive to economic data. I'm going to put out a piece about that later on. But this pound and what's happened to the pound has just really reinforced that. So if anyone wants me to ask about anything else, I could certainly answer a couple of questions. Oh, Aussie. Yes, I will talk about Aussie because talk about kind of fundamentals impacting currency. We have employment data there on the 10th. So that is Thursday in the morning, our time, in the morning, London time. As you can see here, Aussie dollar looking very, very strong as we go into the number. That's partly on the back of some weakness out of the US dollar, of course. And it is the Aussie and the Kiwi are the strongest performers in the G10 today. Where are we looking for now? Well, this double top from November, which comes in at around about 94.5. That is your next level. We're about 120 pips from there. And then, of course, whether or not we get above 90 at 95 and maybe target these highs from October, which came in around about 97.5, will be very dependent on that employment number. The market now is not expecting a great number. So it is quite interesting. The market is rallying, even though we're not expecting a big number coming out of that employment report. In fact, the unemployment rate is expected to rise to 6.1% from 6%, and only 2,500 jobs created. Well, if we do get, stronger jobs data, then that could be really a catalyst for further Aussie strength because there seems to be demand there. And some of you may have read the FT article today. A lot of people looking at whether or not we are potentially going to think about whether or not we're going to think about some. What was I trying to say? Sorry, guys. Whether or not we're with the Aussie, whether or not we're going back into a carry trade mentality, I think that the way that the markets are reacting is saying exactly that. And they're still using the US as a carry trade, almost expecting Yellen and co at the Federal Reserve to backtrack from that, potential Q1 2015 rate hike rhetoric. So that's what it kind of looks like for me. Any other questions, guys? Right. Someone asked about gold. Someone's asked about Eurodollar. I've already spoken about Eurodollar, so I won't mention that again. But someone asked about gold and oil. Now, do watch my colleague Fawad. He writes a lot about gold and oil. He is the resident expert, and I was speaking to him yesterday. He said that maybe the downside in gold is done, and that low that we saw last week, just above the 100-day moving average, which comes in at 1273. Looks like a bit of a low now. We've popped back above that 50-day moving average. Gold seems to be rallying on the back of maybe a touch of risk aversion, actually. But the next level to watch is 1312, which is the 50-day moving average. If we can get above there, that's a bullish sign. Could maybe take us back to the highs from 20th of March, which came in at about 1340. So that's what he's looking at. But do look out for his for all of his comments. They are on forex.com website under market analysis. Someone's asked me about Kiwi dollar. Again, Kiwi, this is a prime example, right? So as the dollar's been doing well, we've just seen a complete retracement in the Kiwi dollar. The high now is back on the horizon, which is from the 1st of April, which came in at 87.02. That is, we're not far away from there now. We're kind of trading just below 86.80. It's 87.02 is the level to watch. Whether or not that we see another reversal from there, that becomes a bit of a double top. We'll just have to wait and see, because right now it looks like the Kiwi dollar is looking strong. It's benefiting from that kind of feeling of carry. That there's a feeling like the carry trade is getting a little bit back on, and we're moving forward now. Just some extras to really add to how you're trading. If you want to trade the carry trade, obviously it's when you go short currencies with very low interest rates, and go long currencies with high interest rates. Remember, they should be fairly stable, but you also need volatility to be quite low. That's when that environment tends to work, or when the carry trade tends to work best, in an environment of low volatility. And so this reversal in volatility, jumping from kind of 12, just above 12.5, all the way to 16 in a couple of sessions. It's not huge, as you can see. It's nothing like the spikes we've seen before, but it is testing that key level of 16. And if we continue to see it push higher, that would be quite negative there. So, that could certainly be negative for risky currency. So do watch out. At the moment, the market, seems to be, or the FX market anyway, is ignoring the volatility, and we're seeing risky FX like the Aussie, like the Kiwi, actually rise on the back of, lesser risky FX, not doing as well. But we will have to watch this closely, because maybe it may not be the traditional carry trade. So just watch out. Things seem to be moving on their own individual fundamentals. And that means that sometimes the carry trade doesn't work as one expects. So that's a bit of a riskier strategy. Euro sterling, I'll quickly look at euro sterling. Euro sterling's a bit boring, actually. It's probably not the best one to trade at the moment, because, as you can see, it's kind of moving sideways a bit. It's obviously, today anyway, it's doing badly because the gains in the pound are outstripping the gains in the euro. But to trade euro sterling at the moment, you need to see where euro dollar and cable are going. So this is just a derivative of it. Obviously, we got through that 50-day moving average at 82.81, which is a negative development, and opens the way to the lows there at 82, even down to potentially the Feb low, which came in 17th of Feb at 81.57. We're still stuck in a range, though. Yes, we're weak in that range, but as I said, if you're trading euro sterling, you've got to know what's going on in euro dollar and cable before you can kind of move higher. Okay, guys, I think that's it from me, really. Thank you, everybody. Someone said, have I got anything on my radar? Well, we have kind of lots of things. Euro, I think some, potential short-term further increase in the euro is there, even though we do think gains will be capped. Likewise, with sterling, we could retest those gains if we carry on the way we're going. I just don't feel very optimistic that the euro is going to rally. I think that's that the dollar's going to rally. I think that's the key thing now, which is leading things. I also think with stocks, I'm going to watch them very, very closely. I think what's been kind of interesting is that even though we've seen European and US markets come under pressure, some of the emerging markets have picked up a bit. So the Brazilian Stock Exchange, for example, that's higher. It had a fantastic run. Its best run in 2 years in the last couple of weeks. So that's certainly something worth watching. The other thing is the other thing is obviously looking at, whether or not stocks is looking very closely at Q1 earnings. I think until we get the Q1 earnings out of the way, it's going to be very hard to take a view on stocks, and it's going to be very hard to push us above record levels. So I think that if we get weak earnings reports, a lot of people will be looking to go short stock markets, or potentially looking to go short stock market. Okay, everyone, thank you so much for joining. We're going to leave it there. It was great for you to join. Please do join us again next week. That is, for more kind of question and answer. You guys asked some great questions, and you really did help get everything on the go. So thanks again for that, and we'll rejoin next week. Bye bye, everyone.